As you entered your 60s, it's time to get pumped for what lies ahead. A time when you can finally relax and reap the rewards of your dedicated labor. But hold up, before you start planning all the fun stuff you're going to do, let's talk about retirement savings. Are you confident you've saved enough to support your desired lifestyle? If not, don't fret. In this video, we'll guide you on how much to save and give you tips on how to grow your savings in the years to come. So sit back, grab a coffee, and let's get cracking. Retirement planning can be a real head-scratcher, especially when trying to figure out how much money you need to save to live your golden years in comfort. It's a bit of a tricky question since everyone's situation is unique, but it all boils down to how much you earn now and the lifestyle you want to live in the future. You need to answer 4 important questions based on your life. When do you plan on retiring? If you're thinking about retiring before the full retirement age, you'll need more savings. It is recommended that you have up to 7 to 8 times your salary, assuming you'll retire at the age of 60. So it's important to factor in the timeline of your retirement plans. What kind of lifestyle are you envisioning? Do you want to travel, start new hobbies, or be philanthropic during your retirement? These goals may require more savings, so it's essential to consider the lifestyle you want to maintain. Where do you want to settle down? If you're planning to move after retirement, it's crucial to research the cost of living and taxes in your desired location. This information will help you plan your retirement budget accordingly. What is your debt situation? While debt can be used as an investment, excessive debt can hinder your retirement goals. Seeking the advice of a financial advisor can help you make informed decisions about avoiding unnecessary debts. The experts suggest having 10 times your pre-retirement salary in your savings account and planning to live on 80% of your pre-retirement income annually. So, if you're currently raking in $100,000 a year, you'll need at least $80,000 to cover your expenses post-retirement. But don't sweat it if you fall short. This number can be adjusted based on other sources of income like Social Security, pensions, or even part-time work. Plus, your desired lifestyle and health can also impact your retirement savings plan. Determine your retirement budget. After understanding your ideal retirement by answering some critical questions, you must assess how much money you'll need to cover your expenses. Determining the monthly amount you can expect will give you the confidence that you'll be able to retire comfortably or allow you to make adjustments now to increase your savings. To generate a personalized income, you can utilize a retirement income calculator, which takes into account the following 4 retirement income sources. What's your expected Social Security amount if you retire in your 60s? If your country has a national retirement system or pension, it's worth checking the age at which you can receive benefits and the amount you'll receive. You may also want to investigate any reductions or increases in benefits based on your retirement age. If there is no national system in your country, you may want to explore private pension options. How much have you saved in your retirement plans? While 401ks, 403bs, and IRAs are common in the US, there are other types of retirement savings plans that may be available in your country. It's important to research what types of retirement plans are available to you, what age you can start taking distributions, and any tax implications of withdrawals. Additionally, you may want to investigate investment options that are available to you to grow your retirement savings. Do you have pension? Although it's becoming less common, some people may have a pension income from their careers. Pensions offer a guaranteed benefit amount based on an employee's income and years of service with the employer. If you have a pension, remember to consider it as a source of guaranteed income when calculating your budget. Do you have permanent life insurance with cash value? While the primary purpose of life insurance is death benefit protection, permanent insurance has other uses. If you no longer require the full amount of death benefit protection, you might opt to receive payments from the policy's cash value to supplement your other income sources. Some of these payments might also be tax-free. When evaluating your retirement plan assets, consider permanent life insurance as a valuable alternative. Tax impact. Have you ever thought about the impact that taxes will have on your retirement savings? According to the Thrivent Retirement Readiness Survey, respondents advised that they should have learned about tax implications for their retirement savings when they were younger. Many of your retirement income sources will be taxed once you start withdrawing the money. Even Social Security benefits may be taxed. This means that a high tax bill could have a significant impact on your retirement savings, particularly if many of these accounts you're relying on are taxed at the same time. This is where the idea of income tax diversification comes in. It means investing in a range of tax-advantaged accounts to help minimize how you're taxed on those accounts, now and in the future. The concept of income tax diversification suggests that you should diversify your holdings into 3 different categories: tax now, tax later, and tax never. Accounts that belong to the tax now category are those where taxes are paid up front. These accounts are best suited for short-term or immediate needs. Checking accounts, savings accounts, and mutual funds are some examples of tax now accounts. Accounts that belong to the tax later or tax deferred category are those where tax liability arises when you withdraw funds. Tax later assets are generally intended for long-term needs, such as college and retirement. Accounts that belong to the tax never or tax-free category generally offer preferential income tax treatment on the accumulated value and distribution of funds. How to start saving for retirement. Now that you have a decent plan in mind, it's time to start saving towards it. The 4% rule is a straightforward formula that can help you figure out how much money you need to save to generate the income you need for retirement. All you have to do is divide your desired annual retirement income by 4%. The formula is easy to use and can provide you with a good estimate of how much you need to save for retirement. For example, if you want an annual retirement income of $80,000, you will need a retirement nest egg of around $2 million, which is $80,000 divided by 0.04. However, the 4% rule assumes several factors, such as a 5% return on investments after taxes and inflation, no additional retirement income like Social Security, and a similar lifestyle to the one you currently have at the time of retirement. It is worth noting that the 4% rule is based on a 30-year retirement period. But if you expect to live longer, you will need to make adjustments to your plan. Medical expenses and other costs can increase as you age, and you must ensure that your portfolio lasts as long as you do. Understanding how much you need to save at different stages of your life is crucial to answering the question of how much you need to save for your retirement. There are several formulas that can help you set age-based saving goals to reach that target. One of the most effective ways to determine how much you need to save is to think in terms of percentage of your salary. According to Fidelity Investments, saving 15% of your gross salary, including contributions from employers to retirement accounts starting in your 20s and continuing throughout your working years, is recommended. Fidelity Investments suggest benchmark retirement savings goals based on your annual income by certain ages. These benchmarks are based on multiples of your annual earnings and are intended to help you gauge whether you're on track to reach your retirement savings goal. There's an alternative formula for saving towards your retirement, which suggests putting aside 25% of your gross salary annually from your 20s. This amount might seem intimidating, but it includes various types of retirement savings, not just 401k holdings and employer contributions. If you follow this plan, it's possible to accumulate your entire annual salary by age 30. Continuously saving at the same rate by age 35, you should have saved twice your annual salary. By age 40, it should be 3 times your annual salary, and so on up to age 65, where it should be 8 times your annual salary. But it's important to remember that life events such as job loss during the COVID-19 pandemic can affect your ability to save and follow 15% or 25% savings guideline. How to boost retirement savings. If you're feeling uncertain about your retirement preparedness, you're not alone. In fact, according to the Thrive and survey, only 5% of near retirees said they're fully ready for retirement, and 44% say they've only done minimal planning. Fortunately, there are still ways to catch up on your retirement savings and renew your commitment to your retirement goals. To prepare for retirement, it's important to tackle high-interest debt like credit card balances. Paying them off now can prevent it from cutting into your retirement savings later. If you don't pay off your credit card debt in full, it can accumulate with interest and late fees and even end up with a collection agency. Since interest is charged daily on credit card balances, not paying them off can lead to a significant amount of debt in the long run. Paying off your credit card debt also has the added benefit of boosting your credit score. As you lower your balances, you increase your available credit and decrease your credit utilization rate, which is positive for your credit score. Having a good credit score in retirement can help you refinance your mortgage or obtain a new home if you plan to downsize. For those aged 50 or older, catch-up contributions to retirement accounts can be a useful tool for boosting savings and reducing taxable income. However, not everyone can afford to contribute the maximum amount allowed. which in 2023 is set to increase to $7,500 for those aged 50 and above. One option for diversifying retirement savings and reducing future tax burdens is to consider a Roth conversion, regardless of where you live. This involves moving money from a tax-deferred retirement savings account into a Roth IRA, which is not taxed again after you pay taxes on the converted amount. This strategy can potentially provide tax-free income in retirement and reduce the amount of taxes you may owe on your future retirement income. Countries around the world may have their own legislation related to retirement savings and catch-up contributions. It's important for individuals to research and understand the specific rules and options available to them in their respective countries. Additionally, the idea of diversifying retirement savings account through Roth conversions can be applicable to many countries. Individuals may have the option to convert their traditional retirement savings accounts into Roth accounts, or they may have similar tax-advantaged accounts that can be used for retirement savings. Consulting with a financial advisor can help individuals understand the options available to them and determine the best strategies for their personal situation, taking into account factors such as income, tax rates, and retirement goals. By diversifying your retirement savings through Roth conversions, you can vary the timing of when you owe taxes on your different accounts, avoiding a large tax burden at any one time. Additionally, Roth conversions can help alleviate concerns about future tax rates as you pay taxes on the conversion upfront and do not need to predict future tax rates. As you approach the end of your career, it may be worthwhile to examine your expenses and determine which ones you can cut back on. Perhaps you could save money by canceling your gym memberships or subscriptions, dining out less frequently, or taking public transit more often. These small changes can help you increase your retirement savings. Lastly, in addition to trimming expenses, you can also test out your retirement lifestyle during this time. For instance, if you plan on downsizing to a smaller home, you could consider moving earlier. The savings you'll gain from lower utility bills, property taxes, and other expenses could significantly reduce your cash outlay. If you're not on track to meet your investment goals, delaying retirement is an option worth considering. Each additional year you work means another year to save money and reduce the amount you draw from your savings. It's also an opportunity to delay Social Security, which can increase your eventual payout until you reach the maximum benefit at age 70. By sticking to these principles and setting your budget accordingly, you will be able to retire in your 60s. Thanks for watching the video. If you learned something, make sure to like it. Let us be financially aware together by subscribing to the channel. And do not forget to ring the notification bell for more videos like this.